Hello, everybody. There we go. How's it going, everyone? Excited to have you with us. It is Training Tuesday, and today we are talking all about RRSPs. So, at your request, many people have a lot of questions about RRSPs. So, hey, Colleen, thanks for joining us. Andrea, hey guys, nice to have you joining us. So, hang on here. Oops. Yes, I want to continue. There we go. Scotty, hello. Thanks for joining us, everybody. So, we're just, if everyone can just let me know if you can hear me. I didn't actually do a real quick test right before. So just let me know if you can hear me. Thumbs up. Hello in the chat. Yes, I can hear you. Something like that. So, hey, Anna, nice to have you. Gino, perfect. You can hear me. Yay, perfect. So, hi, Tisha. I imagine you're here somewhere in there too. So, hey, guys. Okay, so just going to give it about 30 seconds or so, just let other people jump on. So in the meantime, I'll let you know about our boot camp. So we've had, oh my goodness, so many questions about it. Perfect. Thanks, Dave. Terry, yay. Sound is perfect. Awesome. Thanks, Andrea. Colleen, woo. Okay, so our boot camp next week starts August 12th. So it is a joint venture boot camp. For those of you that are looking for joint venture information, it is kind of your first 4 steps in getting started in your joint venture journey. So what do you have to do? What are the very basics that you need? And we're going to get you set. There's exercises. Hi, Donna. There's exercises and all kinds of homework. It's about an hour every evening, and then your homework should not take you more than about 30 minutes. But it's going to give you a really good basis for getting going and making sure that you have everything you need to start talking to joint venture partners. So, perfect. Stormy in Calgary. Hey, Anna. Perfect, Kathy. Thank you. Hey, Logan. Okay, guys, so we're going to get started. We're going to go right into this. So we're talking today about investing with RRSPs. Now, we have people on here tonight that both want to know as the lender of their own RRSPs and how to get their money working for them. And for those of you that are joining us from the US, it's similar to an IRA, and there is a very similar concept for the US with your RIAs. Hey, Craig and Irene, thanks guys for joining us. So if you're watching from the US, the principles are the same. There is a little bit of a difference in how you go about it logistically, and we can certainly connect you with the right people for that. But for tonight's purposes, we are talking about RRSPs, which is like the US IRA. So both from the lender's perspective and from a perspective as us as investors, this is a great way to raise money. So we wouldn't call it a joint venture just because they don't have ownership in the property. By law, they cannot. So it's not really a joint venture, but it is a way of raising cash. So that's what we're talking about tonight. So first off, just want to make sure that everybody realizes, and I'm sure you do, but that we are not accountants, we are not lawyers, so you do have to get, obviously a professional opinion and, make sure that you get professional advice. This isn't advice, this is just a strategy, what we know of the strategy, and how you can use your RRSP cash to make money for you, being backed by good old real estate, as well as how as investors, we can use this as a way to, raise capital so that we can then go on and buy other properties. So that's what we're talking about tonight. Now, in the context of RRSP investing and in the context of having, the registered funds working for us, both as lender and as investor, or a borrower, just remember that we are talking about arm's length mortgages. Now, what does that mean? Arm's length means that they are not that close to you. Okay, so if it's a family member that is not arm's length, they are close to you. Now, there are some exceptions to it. Aunts, uncles, cousins, there's kind of some lines drawn and, some gray areas there. But in general, if you are related to them, then they are not arm's length. That's by blood, by marriage, by adoption, doesn't matter. Now, who's setting that? Who's setting that is CRA. So this is not, a bank's law or legislation, or this is CRA sets what determines a registered plan being able to be invested in a mortgage, and they say that it has to be arm's length. So picture distance, they have to be distant to you. And in many times it's even considered a stranger. So this is arm's length mortgages that we are talking about that are held within an RSP that we're using as investors on the borrowing side, and that we are using as lenders for those of us that have RSPs that we want, our money working for us, and we want it put to good use, and we're sick of making the, returns and mutuals and stocks and all that stuff that, is not really working for us very well, is it? Okay, so if you're a little bit unclear on that, CRA does have a really good description of what signifies an arm's length mortgage. So if you're unclear, you can always check, and it's pretty clear. And I guess just as always, if you have doubts and if you are not sure whether they are arm's length or not, don't take the risk. This is for someone who is a stranger to you that you have no other obligation to, emotionally, psychologically, no other obligation to, and they are pretty much just investing with you as a lender. So how it basically works, what often investors do, and so what we're going to kind of talk about tonight in for the most part, is getting people's money on our properties as second mortgages. So here's a quick breakdown, and I'm not a numbers person, and Corey was going to do this portion, but he's not really feeling great tonight, so just bear with me. I'm going to use really simple numbers just to keep this really easy for me. So if we have a property that is worth $100,000, that property, it's worth $100,000. See, I'm not very good at this. Worth $100,000. It is mortgaged at $50,000. So we have a 50% loan to value on this property. So 50% is mortgaged, 50% is equity. So what I can do as an investor, let's say I own this property. I have a property, 50% equity. The bank will allow me to lend, and a safe investment is considered a loan to value of 80%. So I've got up to $80,000 that I can lend out on this property. So that gives me, now I've got a mortgage of 50 grand. I've got an additional value of 50 grand, but I'm only going to mortgage it to, let's say, 80%. That gives me $30,000 that I can take someone's RSPs. I can put it on my property as a second mortgage. We'll explain a little bit more how to do that, so don't worry. Put it on as a second mortgage, and I will get a check written to me. Now, what can I do with that check as an investor? As an investor, I can go to Hawaii with the check if I want. I can buy dirt bikes with the check if I wanted. Or what most investors will do is they go back and they reinvest that money in another property. Hey, Jake from Bend, Oregon, awesome. And Anne from Montreal. I love it how we're getting so international. We have people jumping on from Asia, I know that, and throughout the States, Canada. Welcome, welcome everybody. Love having you here. So Jake, I don't know if you caught this part, but I'm just gonna kind of review. So we're talking RSP investing. So RSPs are similar to your IRA. So it's a registered retirement account that's administered by the government. And so we're talking about self-directed RSPs. Now when we put, and for you it would be a self-directed IRA. The principle is very similar in the US, again, logistically a little bit different, but the principle and the strategy of what we're talking tonight does apply in the US as well. Oh, perfect. Awesome. We met in, where were we? I don't even remember. The Grand Ole Opry Place, Nashville. Yeah, awesome. Okay, so if we are gonna have this investment account, what we're gonna do is we need to bring money in. We're looking for more money so that we can go out and buy more properties as investors. That's what our number one game plan is always, is how do we buy the next one and the next one and the next one. So we get somebody to bring their RSP money to us. I get a check out I'm going to go and buy another property. So that is the basics of an RSP or IRA for those of you joining us from the States, investment. Now, here's a few key, I guess, misconceptions that a lot of people feel is, let's say we have 100 grand in RSP money. And we feel that we want to bring that money into real estate because we're sick of getting the 2% returns that we're getting from stocks and bonds and mutual funds and all that sort of thing. So we don't really want that anymore. What we want to do is we want to bring, money in and get a good solid return. Now, what's a good solid return? On an RSP mortgage, you are going to, generally speaking, an investor, and what we always paid, on average is going to be between 8 and 12%. So that's what you can count on making on your money. Now, it can go down to, 4, 3, 2%, whatever it might be. I've seen it go up as long as 18. Whatever your, decision between your joint venture, and if you've heard us speak before, you've heard us talk always about how you're catering every joint venture. Every time you're raising capital from somebody, you're catering it to what they need and want. The more risk, so maybe the more leverage or loan to value, maybe you're going to pay more of a percentage, and the lower, of course, lower. So it's all up to you and your partners and what you have to offer, but your average rate is going to be between 8 and 12%. So biggest misconceptions is that you would have to take it out of your registered plan in order to invest it. So we've talked to more investors than we can count that have taken the money out of their RSP and paid the tax on it. Like, that's a tax sheltered, beautiful, tax shelter for us. They've taken it out and paid the 30 to 50% income tax on it and then used it to buy a property. Because we hear all the time, you cannot use your own RSP on your own real estate. And yes, that's true, but you can use it on someone else's. And again, like we just talked about, as long as they are arm's length from you, you don't know them, you have no obligation to them, nor them to you. Awesome, and you already moved a fair amount to a self-directed account. Perfect. So that's what you have to do. So for those of you that are looking to lend out your RSP money, what you have to do is you have to move it from a bank. That can be, Toronto TD, Royal Bank, whoever you're dealing with. You move it from your bank and you're moving it over to a trustee. Now, in Canada, we've got a number of trustees. The one we use the most is, right, Jake? The one we use the most is Olympia Trust. Now, if you go on their website, there is some information on there. You want to look at RRSP, arm's length mortgages, and all the forms there. You're going to print those off, fill them out, and it tells them how to get your money from your bank. Now, what's the difference? You go to your bank and they're going to tell you, yes, you have an RSP, and you can tell me where you want to put it. You can put it in this stock, this stock, this stock, or this bond, or this mutual. Here's your 5 options. We've chosen them for you, but really you're self-directing it because you get to choose of the 5. However, that's not exactly self-directed, is it? A true self-directed RSP is, or account, is where you literally get to choose from the whole gamut of choices that CRA has said is available to us as investors that qualify within a registered plan. The whole gamut, one of which is mortgages. First mortgages, second mortgages, third, whatever, mortgages. Most of us investors will use a second mortgage, but any of it is available. So that's how you start the process. You move it over to a trustee. That usually takes about 3 months though, so just so you know. And once the trustee has it, then you're able to, direct them, Kate, I want to put a second mortgage on such and such property. Here's the appraisal. And then you can start that process. So if there's one huge thing that we'd like you to get out of tonight, it is that please do not take it out of your RSP. Leave it in your tax sheltered plan. It's a registered plan, and mortgages do qualify within that. It's not commonly known, but it most certainly does. Yes, and it took a while for you to understand that you can invest it, but it stays in. Yeah, and that saves us a lot of money as investors, so we're not paying that extra tax. Now, just so you know as well, when you have your RSP account, then the money that comes back into it, so anything that you make on that, 8%, 12% interest, anything you make on that goes back into your registered plan. And again, it's got those tax shelters or tax deferred benefits, but it all goes back into your RSP. You can't grab it out cash. So yeah, as long as that's totally understood. All right, so let me see here. Perfect. Okay, we're going to move on to number 2. So the number 1 is that you do not have to pull it out in order to benefit from it. Okay, so you're going to leave it in your registered plan so that you can still keep the tax shelter. The second thing is that trustee, talking a little bit more about that. So we've got obviously Olympia Trust that I just talked about. It's a great resource. We use them many times. But a couple other ones that we have, Genworth, Canadian, CWT. I've actually never used either of those. And then TD Waterhouse used to do them, and they kind of come in and out of doing them, but certainly a couple different options for you. But if there's one thing that you have to remember about having your trustee, is that all they do is administer it for you. They are administration, period. They don't give you advice. They don't double check your numbers. They don't double check that you did things properly. They don't double check the leverage. They don't double check the appraisers that you've used or anything else. It is up to you to do all of those things. So really important that when we go through all of these things, we remember that the buck is on us as lenders and as investors that are accepting not joint venture cash, but capital as RSPs. As investors, we have to remember that the buck is definitely stopping with us, and all that they're doing is administering it. They do not protect us in any way as lender or as borrower. So we really have to hone in on due diligence here. So I see some questions. If RSPs in a TFSA, then you earn interest tax-free, correct? That's my understanding. Yes, then it can be tax-free, not tax-deferred or tax-sheltered. But, again, confirm your strategy and everything that you're doing with professionals. But yeah, that's my understanding. And yeah, for sure, we've used Olympia Trust for a lot. We've done many, both as borrowers and as lenders, and it's definitely a very beautiful, beautiful thing. So, okay, so let me see here. Yeah, there's no responsibility, and that's a big, huge thing. So I've seen a few things that I wanted to kind of give you a caution on. So we have seen where a normal bank will say, I'm going to lend up to 80% LTV. So you can leverage or mortgage a property up to 80% of its value. So again, we're going to use a really simple number of 100 grand. Then you can have an $80,000 mortgage on it, or debt up to $80,000. We have seen though, where people are fine with leveraging up to 100% and even over 100%. Again, if you get, the wrong appraiser or the right appraiser, however you want to look at it, I'm going to say wrong. Thanks, Amanda. That's so sweet. Then if you are doing all of these things, you have to remember that it's up to you to make sure you're not over leveraging someone's property, because that can be a really dangerous thing. So, keep your questions coming in, and I'll go through and kind of, address everything at the end, those that I miss. But please watch that you're not over leveraging both yourself as an investor, because one thing we have to remember, if we're accepting RSP funds on our properties, if we're accepting that, the extra mortgage that we have on there has to be covered by the cash flow. If you're not covering your cash flow, and again, it's kind of expensive money, you're paying 8 to 12% on average, and if you're not making sure that property can more than cover the cash flow, then you might find yourself in a bit of a tight position. So you don't want to be over leveraging yourself, and you don't want to be allowing it to cut into your cash flow too much, because that does catch up to you. Yes, maybe you got to buy another property, but it does catch up to you if you over leverage. So, and then from a lender's point of view, if you come in with your, money and you allow someone to over leverage themselves and cash flow gets tight, or the market goes, gets a little bit tougher or whatever it might be, and you're the lender on that, then again, you've put yourself in a bit of a finicky position where it's a little bit scary. So as a lender, you're going to set your loan to value. What are you willing to accept? Again, a bank, conventionally banks say 80%, which is great. Awesome. Some say 65%. Some want 75%, then with a little bit extra cushion. It's all up to you what you decide to set as your standard. But of course, again, you'll have to find someone that's willing to give you that on both sides of the coin. What is your typical more than cover percentage as a minimum? I'm not sure. What did I say? Did I say more than cover your cash flow? I think I might have said that. Lori May, reminder about cash flow. Make sure you have a cushion in case the market softens, for sure. You don't want to end up, paying out interest every month out of your pocket instead of out of the cash flow from a property. Jake, I'm not sure if I understand your question. Maybe give me a little bit more clarity. I probably said something that said more than cover, and now I don't even remember what it was. So let me know what you're kind of talking about there, if you could. And Corey is on as our moderator here. So, hon, maybe you can answer that question if I'm not getting to it. So let me see. Hey, Sean, still in New York. Awesome. Saw your pictures on Facebook. Awesome. Versus the note payment, what is your recommended cushion? Oh, I see. So like cash flow. Okay. So, it's generally speaking, it's a percentage. It's not like a dollar amount. So depending on your market, if you have, for me, I'm not going to say, if I have a property that's cash flowing $100 a month, that's a pretty high risk for me. I want quite a bit of cushion there. I want to be cash flowing, in my market, that's like $400 to $500 a month. But again, that's based on a return that you're going to get. So a cash on cash return every month. There isn't really a number. It's more based on percentages. So it's based on your ROI and how your numbers have kind of worked out. And I'm going to get Corey to answer that even better, because I'm not very good with numbers. But in my market, it's going to be at least $400 to $500 a month. And if I can't cash flow that, I'm not really interested in a property, whether that's a first mortgage or nothing. 20 to 30% above the note. So I think the note is a mortgage, I believe. We have different terms in Canada. Okay, there we go. Good. Corey's on it. Perfect. Awesome. Okay. So just remember to watch your leveraging. That's what you want to watch. Don't be over leveraged, and don't give to someone who is over leveraged. All right. So I know I mentioned it, but our third point tonight that I really want to talk about is that it is both amazingly great return on your money and very expensive, depending on whether you are the loaner or you are the borrower. So again, right now we can get mortgages and line of credits for about 3 to 6% for the average person, the average investor. And that's a really good rate. That is free money. So that's where we're going to probably go to immediately, is we're going to go to a, first mortgage from a conventional lender. After that runs out, if that's, no longer an option for us, then yes, RSPs are a great option. It's easier to, get someone's RSP money invested with you as when you're raising capital, whether it's RSP cash or joint venture. It's easier to get someone to give their registered funds to you because there's a trustee involved, and it just seems to go smoother. Plus that money is not doing anything for them and they don't want to take it out and it's not liquid for them anyway. So it's easier to convince someone, or not convince them, but have them invest with you through a second mortgage. Much easier, but also much more expensive. So just remember, you're paying between 8 and 12%. You can be paying a whole lot more than that. You can pay a little bit less than that. But it's expensive money as investors. So the nice part is that generally speaking, it can be paid out at any time. So that's one thing that in an RSP mortgage agreement, you will have in there as an investor, you will have in there that you definitely want to be able to pay them out at any point. And maybe you can reuse that money on a different property, but often a refinance with a first mortgage from a conventional lender is going to be a lower percentage than what you would be paying out to an investor. So, make sure to put that in your paperwork that you definitely want to be able to pay that out. And the second that you can, you'll find an alternative lender, I guess, for that. So often a refinance is the best way to go there. Okay, so just in review, arm's length. Arm's length mortgages has to be somebody that you don't know, somebody that's a stranger, certainly not somebody that is related to you, so they can't be related in blood, marriage, adoption, brother-in-laws. There's some gray areas, but again, check CRA guidelines for that. Those of you that are joining us from the States as well, this is obviously, we call it an RRSP, very similar strategy for you guys in using your IRAs. Leave it in the tax shelter, don't take it out. You're going to want to leave it right there so that you don't pay any tax on it, which is an unnecessary thing to do. And then that you are hiring a trustee, and again, a trustee does not mean somebody that's looking out for you, has a second set of eyes, or is checking your numbers or your appraisals or who you're using or what somebody says you have a property value it at. A trustee is only administering it in the way that you direct them to. So the buck stops with you, and you really have to do your due diligence both as a lender and as a borrower for RSP money. So yeah, that's our content for tonight. 3 things: arm's length, leave it in your tax shelter, don't take it out, and your trustee is not your second set of eyes. So I am just going to open it up for some questions here. I'm going to go through a little bit here, and hey, Anne and Anna. Oh, we have 3 Annas on tonight, and an Anne. Jake, we had lunch in Nashville, didn't we? It's all coming back to me now. All right, let's see here. What do we got going on? You can just put your questions in here below, and I will go through here. Anita, yep, RSP investors was surprisingly easy. Yeah, there is a trick to it. I will tell you that the first time we tried to do it, I was in tears, literally in tears. And I was like, tell me, Olympia, tell me, what is it that I'm doing wrong? How come you won't fund this mortgage? I've done every single thing that you need. And their answer to me is, we cannot give advice. Something on the paperwork is not filled out properly for what you're wanting. Sorry. So once we got it though, then it was just like clockwork. And the beautiful part of this is that once you do start attracting RSP money as a working partner, you do start getting a lot of referrals, because all of a sudden they're like, hey, I made 10% in my RSP last year, and they're telling their whole family and all that. So there are 2 things. Sorry, 2 things that I want to make sure to get to just as cautions that are, because there is some legal liability, of course, in all of this kind of stuff. RSP in your TFSA, yes. Sorry guys, just give me a second here. Lots of chatting. Awesome. Taking me a little bit to get through it here though. All right. Hey, Rhonda, I didn't see you jump on. And Douglas, hey guys. Do you have a go-to strategy for identifying and approaching people wanting to leverage their RSP IRA funds to invest in real estate? Yes, Jake. So you can get some really nice information out there online about the average American, in your case, how much they are getting in their RSP. And so what we did was we took that and we put it into Excel and we made a nice little graph, and it basically said, here's what the average American is making in their RSP, and here's what the average investor makes in their properties. And, it was like 21% versus, and this is annual, 21% versus the 2% that they're averaging in an RSP or a IRA based on mutual fund stocks, whatever they're investing in. So that often is an easy conversation starter where you just say, when you're talking to people, it'll be like, oh yeah, I use people's IRAs and invest in real estate, and I'm able to provide a return of about 12%, and so they like that a lot better than the 3% they make in general. And that kind of opens the conversation to people, and they're kind of like, okay, what? Okay, wait, what? Because I have some RSPs that I need to use, or I have some IRAs that I need to use up. And I'd love to get a better return than what I'm getting. So absolutely, that's just opening up that, and then giving them the graph and be like, yeah, check this out. Here's the sources that I got it from, and isn't that crazy? But yeah, I can show you how we get our returns, and if you ever want to talk, let me know. That sort of thing. All right, Irene. I have money from my accounts to lend on mortgages and very happy with the returns. Yeah, it's a nice, safe way to lend. And the nice thing about it is it's just a constant. You're just getting constant returns. It's simple interest. It's not compounded. It's easy to keep track of. And the fees are relatively low when you use a trustee. So let's see. Common trustee fees. Yeah, perfect. Good question. Good timing for that, Dave. So common fees are actually not that bad. Now, it's been a little while since I've done one myself, so I'm just going to go from memory here. I probably should have freshened up, but I believe it was about $250 to fund that the trustee will charge you, and it's about $125 a year. Now, that gets charged to the RSP account. That gets charged to the lender. So the lender has to remember that, they're getting a good return of 10%, let's say, but they all are also having fees come off. So I think the first year fee is about $350 with all the fees in. And then after that, it's about $125 a year, if I remember correctly. So yes, another one has used, Donna, you've used it. Awesome. And Lori May, yep, lots of experience, I'm sure, in using RSP funds. Okay, Colleen, so what are the disadvantages of being the borrower of an RSP? So I may already have covered that and missed this question, but just in case I didn't, Colleen. So it's just expensive money for us. So, we would often take in RSP money, put it down, we'd be paying, let's say, 10% to our lenders, which is great. It helped us to buy extra properties. It helped us to scale and move forward, but it was definitely a little bit expensive. So it's sometimes a great interim thing for even a year, maybe 2 years, but sometimes it can be a little bit expensive to keep on. So we often would give back the money to the RSP, pay it out with all the interest, and our lenders were extremely happy. And then after that, we would, look for the next property or find a different property that it really would work for again, that it made sense to do it on again. So we often used it for 1 and 2 year periods, maybe not long term, just because it does get expensive. So, yeah. And other than that, Colleen, I don't know, disadvantages. You know what? We found it a great strategy, and it really helped us scale quite a bit. So, not too many disadvantages, I agree. Let's see. Awesome, Dave, good. And let me know if this is making sense, because I ramble. For those of you who've seen me speaking from stage sometimes, oh my goodness, I ramble so much. So stop me in my tracks if I'm going on. Another cost are the legal fees to drop the mortgage documents, for sure. Yeah. So, once you get adept at doing that, Donna, generally speaking, you have a mortgage that is pretty standard. And, one way to save in legal fees is you can amend the mortgage yourself to fit, the property, legal description and all those kinds of things, your borrower, your lenders, all those things. And then just have your lawyer review it instead of have them draft it. And you can go from, saving, probably $1,500 even on fees. So that's what we often do with our contracts. We use the ones that we already have, and then we have our lawyer review it for us. And that usually takes about an hour of time, which is $300 to $500, depending on your lawyer, depending on how complicated it is too. And that can save you some money in fees as well. Yes, Jake, often RSP money is less expensive than a hard lender, for sure. Hard lenders are, hard for a reason. So, Andrea, those going to 100% would be offering additional security, I imagine. How are they achieving that, to your knowledge? So, they don't always offer extra security. And so that's a bit of a problem. They might tell you that, our market is set to boom, that won't be a problem. Or we're going to do renovations with that money, and the property's going to go up in value. And, there's a lot of things that they might say, but how they're actually giving you security, extra security, I don't know that they are. So that's one of those things that I say. You want to make sure that you are setting your, loan to value limit. And again, I always say, we always say to do that without emotion. So you're going to do that when you don't need the money and when you're not desperate for anything and when you're not under pressure. You're going to set, this is how much I'm willing to pay as a lender. This is how much I'm willing to pay out as a borrower, and to use as a LTV for my lenders. This is my max. I'm 65%. That's it. If they're over leveraged over 65% or 75%, I'm not doing it as a lender. And you might say to your lenders, if you're the borrower, say, the max I can pay is 8%, and I'm not going over that because the numbers don't allow me to. So you're going to set your standards, and you're never going to go past them. And again, in a non-emotional time, you're going to do those things. So there are a couple of other things where you can trade RSPs. So again, how we talked about arm's length mortgages? You can trade RSPs. So hang on, I'm just writing these down. And I'm going to go through all the questions first, and then I'm going to get to the extra questions that I had come in before this. And Anita, you're right. It's more expensive money, but it is flexible money. And Lori May, often the borrower does pay to drop the mortgage documents. Though in our buying stage, we didn't know well enough to do that often in the beginning. And so we would do them. But again, for sure, it's up to each thing. Yeah, Jake, Canadian Realtor friends setting up a referral for sure. Thanks, Lori May. I'm okay with the numbers, am I, for right now? Carolina, hey, welcome. Okay, it doesn't look like we have questions past this. Wow, I think I got them all. Anita says it's a good idea to check if your lawyer does the paperwork for RSP seconds. You're right. There are a lot of lawyers that don't quite understand it. Plus, it's kind of a pain. So some of them don't do it. And so that's another reason why sometimes just getting them to consult on the actual contract has been a good thing as well. But yes, you're right. Not all lawyers will do it. We do know quite a few across Canada that will, though. So if anyone needs a referral there, again, let us know. So a couple of things. So first off, in Canada, we have to be very careful as joint venture partners, including with RSP funds, when we're raising capital, period, in any capacity as a partner or just as a borrower. We have to be careful that we don't contravene any SEC or Securities Commission rules. So we have to make sure that how we're saying and what we're saying is not a enticement to getting people's money. So how can we do that? So one way is just by being really vocal about what you're doing. So you don't have to ask someone for their money. You can just say, this is what you're doing with other people's money. And so if you, whatever province you're in, there's all these different boards. They all have very, very similar rules, but each province is different. So if you look up your own securities commission, like Ontario Securities Commission, Alberta Securities Commission, it will tell you the rules and it will tell you what you can and cannot say. So you'll start to get down pat, and we talk about that a lot in our courses, is, you know, you'll start to get down pat what you can and cannot say. But the idea is you can't be soliciting for people's money. And so even though we think of that as being for like big, you know, money investment firms or whatever, you have to be licensed in order to do that, it actually does apply to us as well, both as joint venture partners and as people raising capital through RSP funds. So, you know, keep that in mind. Look up the rules so that you're not contravening anything. So, Sierra. Hey, Sierra. When approaching using RSPs for the first time, what are some good resources to refer to? So depending on where you're from, I would look up and find the typical return that your typical person is going to get on a mutual fund, RSP or IRA, and find out what the return was for, say, 2018, or you might, actually numbers might not be in for 2018, so even 2017, and then show them what your ROI numbers are for the properties that you have. So where tonight's training is specifically dealing with, you know, in investments from RSPs, we're going to assume that you have a decent base in understanding ROI and cash on cash return and all of those things. So if you have your decent base and you're showing them, hey, look, this is how much our cash on cash return is, or this is how much our ROI is, or whatever it might be, then it's a pretty easy way to say to them, hey, you know, do you want 21% or 15% or 30% or whatever you're offering in your properties, whatever you can substantiate in your properties? Do you want that return, or do you want what you've still been getting? And so that's, you know, just Google it, find out for your area, and it's an easy introduction to people. A lot of people don't even realize that. Have we experienced default, and how have you responded? Have we experienced default? No. Excuse me one sec. Ooh, sorry, just got a bug in my throat. So have we experienced default? No, nobody has ever defaulted on us. We have never defaulted on anybody. I have heard of it though, and the biggest caution that I can give you, again, is what we talked about earlier, is just make sure that they're not over leveraged. If you are lending your RSPs out to someone, make sure that they're not over leveraged, and make sure that they have a good understanding of, you know, how money works and real estate works. Myself, I wouldn't even be against, you know, doing a credit check or having them supply a credit check for you so that you know what you're getting into, because, you know, you want someone who's going to pay your payment on time and, you know, make sure that everything's administered properly. You want somebody that's running a business, not just has an investment property, but is running a business. So no, we've never defaulted. I have heard of it, but the only time I've really heard of it is when people have, you know, over leveraged, and deliberately or non-deliberately. So just make sure that your LTVs are in line before you invest, and you should be good to go. Cheers, Jake. Thanks for joining us. Darren. So glad to have you here, Darren. All right, Sierra, if you've never structured an arm's length mortgage before and you don't have the success to back you up, how do you handle those concerns? So good question. It's the same concerns that we have as joint venture partners when we start out with no experience. So Sierra, I don't know if you know our story or not, but we started out at 24 years of age. We didn't have any experience in real estate. We'd read a lot of books, gone to a lot of seminars. We'd taken some courses. I'd listened to the DVDs, or CDs. I mean, that was right back when there were CDs. I even got one set on tape. Like, this is, you know, how long ago it was, and we were 24 years old. Now, how do you handle it? It's the same way as you do when you actually have, you know, you're looking for any kind of capital and looking to get anybody's support in real estate. You have to show them what you do have. Now, for us, we had drive, we had determination, and we had, you know, some spunkiness. Like, we would go to events and talk to people, and we would, you know, talk to our family, and we did silly things like wearing shirts that said, you know, that we invest in real estate. We kind of, people could feel that there was nothing that we wouldn't do to attract money. And so they knew that's how we would also attract properties to our portfolio, how we would attract our tenants. So we went in with what we did have. And so, you know, throughout our, actually in the boot camp, you should join us for the boot camp. Everyone should join us for the boot camp. It's August 12th starting. It's a 5-day boot camp. And we're going to start a basis for what do you have to offer? Even if you have no experience, even if you have no money, you do have something to offer. And my favorite thing is how amazing stay-at-home moms are at being investors. They are some of the best investors that you're going to find. And they may not have any experience, but I tell you, they can absolutely run a household. They are great with people. Tenants love them. They are on everything. And you know what? It really, really is just a matter of how you present your value proposition. Who are you, Sierra? What do you do? You know, maybe you're an engineer in your real life, or maybe you just got out of high school, but you're willing to hustle, or whatever it might be. There is something that you have that an investor will look at. And I can tell you, I'm only 42 years old, but I've been in real estate for a long time now, and I look at it and go, okay, I'm tired of property management. I'm tired of swinging a hammer. I don't swing hangers. I swing hammers. So, you know, I can tell you that I'm tired of some of these things. And when I see a young whippersnapper, I look at them and go, wow, I could totally invest in them because I'm investing in who they are. Not just their experience. I'm willing to learn with them, and I'm willing to let them make mistakes even. But I want to invest in who they are and what they're going to do. And I want to leverage their energy and their time and their determination and their drive. So that goes for whether we're raising joint venture capital or RSP capital. You're going to talk about what you do have. So join us for our boot camp, and we're going to get you started in those kinds of things. That's one of our pillars that we're going to be dealing with in the course next, or the boot camp next week. And that should give you a really good start. Is any of this making sense to you guys? I hope so. Got a little bit quiet now. No more questions coming in. So I'm hoping this is making sense. Let me see here. Yeah, awesome. Okay, one more concept that I was just going to review with you is because you have to have an arm's length mortgage. So because your RSPs cannot be with someone you have like an obligation to, you know, family-wise or related to. One really cool concept that a lot of people do, or strategy, is that people will trade RSPs. So let's say that I have some, or someone in my family has someone, and I want that money working for me, but I can't put it on my properties that are only mortgaged to 50% LTV. I can't put it on those, but I can put it on someone else's. Now they have RSP funds too. Perfect. Thanks, Demi. It's making sense. Awesome. Thank you. So now they have RSP funds. They can put it on my property that's mortgaged to 50%. Now my understanding is that you can't make that as part of the deal. You can't be like, okay, I'll give you my money if you give me your money. That's not how it works. That's my understanding of it. And you can't make that part of the deal, like as a caveat. But a lot of people will do that. Be like, well, I've got approximately this much, and I've got approximately this much, and maybe we can switch. Another thing that we've done before too is we actually put an RSP second mortgage on our personal residence. Awesome, Kathy. Yes, Julio, this is to learn how to use RSPs in purchasing a property, you bet. Awesome. And supplements Keyspire info, perfect. For those of you that don't know about Keyspire, it's a great education forum as well. So, okay, yeah, get back to my, so what we've done before is because we had a very low loan to value on our personal residence, we have taken funds on our personal residence and used that as collateral for an investor, and then taken that money and bought other properties. Now, you know, it's kind of expensive money to have on a personal residence, but the money that we made in the purchases that we were able to buy that we wouldn't have been able to definitely outdid, you know, the 10% simple interest that we were making over here. So again, it's all about the numbers and making it work. But if they don't have, you know, a rental property or an income property that has that low of LTV, They might have a personal residence, and that might be, as a lender, what you feel better lending on. And I know we've had questions about that all week long, of how you can secure your interest as a lender. So you are putting a caveat, you are putting a lien on the property when you provide that RSP, and that's what your trustee does for you. But sometimes if you don't want to go above LTV that they have on their rental properties, sometimes you can do it on their personal residence. So that's another option for you as well. Lori May, I understand you cannot actually trade anymore. You can lend to person A can lend to person B can lend to C. Yes, made yourself dizzy there, me too. Yeah, it's not a trade. You actually can't trade straight across, but you can basically say, you know, like for example, I'll just tell you how we did one. So I had a family member with RRSP money. So we took it was like $90-some thousand and gave it to an investor, and that investor did, you know, whatever they did with it, put it on the property, and they went out and bought more properties. That person also had some RSP mortgages. So that person RSP money. That person put it on properties that this guy owned. And again, it can be in corporations, it can be personally, it can be all kinds of different ways that makes it separate legal entities. And again, we do nothing that is, you know, shady or gray areas. It's always above board. It's always checked by a lawyer. But it's not a straight across trade. You're right. You're not allowed to say, hey, I'll give you this if you give me that. But you can certainly make sure that, you know, we're kind of making sure to take care of each other's money kind of thing. So yeah, I think that's about it, guys. Unless there's any more questions coming in. I'll just quickly, for those of you who just joined us, because there's quite a few that have just joined us, we talked tonight about 3 main things. RSPs have to be arm's length, which means you can't be related to them. You can leave it in your tax shelter. Don't take it out of your IRA. Don't take it out of your RSP. Leave it in. You don't want to pay the taxes on it. It's a beautiful thing that CRA has allowed us to use mortgages as one of our investment vehicles within an RSP. Absolutely. So go ahead and do it and use it. And then the third thing, the biggest thing, is that your trustee is not watching out for you. Your trustee is only administering what you say to do, because they are directing your self-directed account. So you have to really be strong in your due diligence. And a lot of people make the mistake of thinking that they're checking things for you. They say, here, we need these 5 things, send them in. As soon as we have them, checks our boxes, we can fund your mortgage for you. They don't check and make sure that all of those things are, you know, true or appropriate or, you know, seem right or relevant to the market that you're in. That's your job to do. So those are the 3 biggest things that we can tell you about RSPs. So yeah, let's see. I think that's it. So I don't think we have any other questions. So I'm going to love you and leave you. I will just remind you of our boot camp next week, August 12th. Please invite anybody that you think would benefit from it. We are really just trying to put out there the very best information, get you really going and really started really well on being able to go out and talk to joint venture partners. We will, you know, as we go, let you know about the mentoring that we do and that sort of thing. So if you do want more, you're welcome to take it, but you will walk away from this boot camp with more than enough information that you'll need to be able to go out and start. And there's homework every night. There's bonuses for joining us live. But it's all just to give you a really good base in raising money from other people. So thanks, Darren. Lola, can you use life insurance money, the cash surrender value? You know what? I don't know. I don't know that. I'm not sure if you can. Maybe you can. I know in the States it's a thing that I've seen a lot of. I don't know that we do that here, and I've never heard of it. But you know what? Never know. I know that our life insurance, we have a really good policy, and we've had it since we were about 20 years old. But, you know, I don't know about whether or not that value is really worth our time and effort, because it doesn't really come out to very much for us. But anyways, yeah, I don't know the answer to that. Fatima. There we go. Okay, guys, I think we're done. So thanks for joining us tonight.